Okay, well now let's look at a bond issued at a discount. So again, a bond is issued at a discount when the current market rate of interest is greater than our stated contract rate. Okay, so the person that's purchasing this bond holder could go out and buy a bond from another company and get a 13% return. Well, our return is 12%. So in order to make our bond attractable to the bond holders or the bond purchasers, we are going to discount this bond. So we are going to say, okay, you can give us less cash up front, and then we'll pay you the 12% interest rate over time. So we're paying you less interest over time. So to account for that, we're going to say you can discount the bond, so you're giving us less cash up front. We still calculate interest on the principal value and the stated interest amount, and we still pay back the full face value. They are just giving us less cash up front. Okay, so that's our way of making the bond attractive.
You're saying that we don't pay them the interest, right?
Yeah, we're going to pay them 12% interest on the $100,000.
When they cash in the bond, or?
Well, on those 6 months payments of interest. So every 6 months, we'll still pay them 12% of $100,000. And then when the bond matures, we'll pay them back the full face value of $100,000. They're just giving us less cash when we issue the bond because we are paying less interest than they could get elsewhere.
Okay.
Yeah. So that's discounting a bond. So when our interest rate on the bond, on the stated interest rate, is less than the market rate, we discount the bond. Okay, so this one is January 1, year 1, Western Wyoming Distribution issued the following bonds. We have a face amount or principal value of $100,000. The stated contract rate is 12%. We're paying interest semi-annually, June 30, December 31st, for 5 years, and the market rate is 13%. Okay. So here, again, because the contract rate is less than the market rate, we're going to sell this bond at less than face value. They're going to give you the amount or the percent that the bond sells at. So they actually told us the bond sold for $96,406. Okay, they might have told us that this was 96.406%. You know, they may give it to you as an issuance like 98. We issued it at 98. But they actually told us how much we sold it for. So we're going to debit cash for the amount that we actually received. So we actually received $96,406. Then we calculate the discount. We take the face value minus the cash received to get how much we discounted this bond. So we discounted this particular bond $3,594. That gets debited to an account called discount on bonds payable. Okay. If you notice below, it tells us what discounts on bond payable is. Discounts on bond payable is a contra account. It's a contra liability or a contra bonds payable account. Payable liability accounts normally increase on the credit side. This is a contra account, so discounts on bond payable increases on the debit side. So it's normally going to have a debit balance. Okay. So we calculated that. That's the discount amount. This is the issuance of the bond. So when we issue a bond at a discount, we debit cash. We debit discount for the amount below the face value. Okay. And then we have to look at, when we calculate interest, interest is calculated the same as far as how much interest we're paying them. But we want to take this discount amount and spread it over the life of the bond. We want to amortize that discount. So again, that's when things get a little trickier. So what we're going to do is we're going to take that discount and spread it over all the interest payments we're making. Well, for instance, this was a 5-year bond, so we're going to make 10 total payments. So in order to figure out the amount that we recognize of that discount over a period, we take the full discount and divide it by the total number of interest payments. Okay, so your total number of interest payments is always your term in years times 2. So 5 years times 2, we're making 10 total payments. Bless you. Okay. amortize a bond discount, we would debit interest expense and credit discount on bonds payable. A lot of times we do it all as one compound entry with the interest payment itself, okay? So what we're doing is we're taking that discount amount and we're recognizing how much of that is an expense. It's a great noise, isn't it? Not distracting at all. So we're taking that discount amount and recognizing the expense of that discount every period that we make an interest payment. So we would take the full discount amount, divide it by 10 to get the amount of discount we're recognizing every period. So we are going to do this journal entry. We're going to have an interest expense. The credit on bonds payable is going to be 1/10 of the total discount amount. Okay? And then we're going to credit cash for the semi-annual interest payment. So the cash amount here is going to be your typical interest payment. So you're taking face value times interest times time. Okay, and we'll look at that in a minute. So then we'll add these two together. We'll add the amount of the discount expense we're recognizing plus the cash payment we're making to get the total interest expense in that period. Okay, so the interest expense on a bond with the discount is going to be the amortized portion of the discount plus the interest payment we're making, because that's the whole expense. The whole expense of issuing this bond, well, we discounted it, plus we have to pay the interest. Okay. Do what? Maybe you locked yourself out. Maybe it's that noise that closed the door. No, sorry, do what? Which entry? Oh, that'll be your discount on bonds payable that you're recognizing each period. So we're going to use what we call straight line amortization. If you can imagine, it's kind of like depreciation. It's the same amount every period. It's the easiest way. The effective interest rate method is required for accounting purposes, but it's kind of complex. And if you work in accounting, you're going to do that all computerized. It's all going to be calculated for you. So we're going to use straight line method of amortization to make life a little bit easier. And that way you can understand the functionality of bonds. Okay, so let's look at this bond we were just looking at. So the discount on the bond was $3,594. The term was 5 years. So the semi-annual amortization, all that means is that that's the amount of amortization. That's the amount of the discount that we're going to recognize every time, every 6 months. Okay? So we take the discount amount and divide it by 10 periods. So again, we get this 10 periods because that's how many interest payments we're making. 5 years of payments twice a year. Okay? So that's where they get the 10 periods. So we take the full discount amount divided by the total number of interest payments over the life of the bond. So every 6 months, we want to recognize 1/10 of the discount, or $359.40. Okay. So the whole payment, the whole interest payment, the first one, is going to be cash is calculated again at the interest rate. So you're truly taking principal times interest times time. You're using the face value and the stated rate of interest. Okay, so it was what, 100,000, and I think it was 12% divided by 2. So 100,000 times 6%. So we're paying them $6,000 in interest, and then we recognize $359.40 as 1/10 of the discount. We add those two together, so the total interest expense is $6,359.40.
So that value on the discount is never really even, we never received it, but we're going to end up paying it back.
Correct.
So do we pay it back to them every
No.
time we pay, or is that all at once?
All at once. Yeah, what we do is when we issue it, they give us the discounted amount, and then when it matures, we pay them back the full face value. So that's when they get it all back. Yeah.
But we're not paying that out right now, we're just,
Correct. Yeah, we're just recognizing the expense right now. Yeah.
so why didn't we just do it all together?
Well, we have to make 6-month payments, right? So remember with the matching principle, that discount is an expense of issuing the bond, right? That discount on bonds payable, it costs us money, we discounted the bond, so that's an expense to us. So we have to recognize it in the year that the expense was incurred. So that's going back to like the matching principle and expense recognition. Okay. So we're going to make this same, once you do it once though, this is the same journal entry you're going to make every 6 months for 5 years. Okay. So you only have to do it once at least. It's just remembering, you know, how to calculate the discount and then that you're spreading it out or amortizing it out. Okay. Okay. Let's go back to the practice. So go back to Cengage, and we're going to go to that second one. And we're going to look at a bond that sold at a discount. Okay. We're going to do one together. Okay. So on the first day of its fiscal year, Chin Company issued $10 million of 5-year 7% bonds to finance operations of producing and selling home improvement products. Interest is payable semi-annually. The bonds were issued at a market interest rate of 8%, resulting in Chin receiving cash of $9,594,415. Well, again, this tells me if I'm receiving less than the face value, that this bond was issued at a discount. Okay. This bond was issued at a discount. So let's do the first journal entry where we're issuing the bonds. What would I debit and credit? Debit cash, good. For how much? Is it face value on that one?
No, cash you received for $9 million.
Right, yeah, on that one, when it's a discount, we want to debit cash for the $9,594,415 that we received. So cash gets debited. $9,594,415. Love the big numbers, right? It's fun. What else do we do?
Debit's a discount on bonds payable.
Right, we're going to debit discounts on bonds payable
And credit bonds
and credit bonds
payable.
payable. Whoops, wrong one.
And most of them, when you just get the face value and subtract the $9 million and you get the discount. That's a debit.
Oh, there we go. So yeah, the bonds payable gets credited for the face value because that's the amount we're going to pay back when this bond matures. So we debit cash for the cash received. We credit bonds payable for the face value of $10 million. And then, like Megan was saying, we subtract to find the discount on bonds payable. So what was our discount? $405,585. Okay. So the discount on bonds payable is the total face value minus the cash received. And we debit that. Again, discounts on bonds payable is a contra bonds payable account. Okay. And then on number 2, it wants us to journalize our first semi-annual interest payment. Okay. So again, the first thing we need to do is figure out our amortized amount of our discount, right? We need to figure out 6 months worth of the discount. Well, this was a 5-year bond, so that means we're making 10 payments. So the amortized discount is going to be the discount amount divided by the number of payments. So 5 years, 2 payments each, so 10. It's always nice when you can divide evenly, right? And they want us to round to the nearest dollar. So 40. Because 6 months worth of that discount is $40,559. Okay, we know we have to recognize that. And then we need to calculate our interest. What would my interest calculation be? What would
you
I?
do it off of the 7% or the 8%?
You will do it off of the stated or the 7%. Yeah. Would I calculate it off of the face value or the discount amount?
Face value.
Face value. Okay. So your interest, it doesn't matter how the bond was issued. Face value, discount, premium. You're always going to calculate interest, the face value times the interest rate times time. Okay, so it's 10 million times what? 7% divided by 2, or 3.5%. So we're going to pay them interest of $350,000 every 6 months. And most likely these $10 million in bonds aren't held by one person. It's probably several people that hold these. We've sold several bonds, total worth $10 million. Okay.
Is it possible for more than one person to have an actual bond or anything?
Have a bond, what?
Is it possible for like a group of people to get together and be like, we'll do this amount of money?
They could, it would just be in one person's name though, unless they had like a trust or something. So that would be the, we would only issue it to one person, but they could split it up however they chose. Yeah. Unless you had like some kind of trust set up where you could divvy it up. That gets, kind of messy.
Is it possible for other companies to buy bonds from other companies?
Mm-hmm. Yep. Yeah, and that's a lot of where bonds come from, like especially higher dollar bonds. Mm-hmm. It's a good investment option for companies too. So yeah, that happens a lot. Okay, so on number 2, we know we need to recognize $40,559 of the amortized discount, and we need to make a cash payment of $350,000. So how do I structure this payment plus recognizing the amortized discount? What do I debit?
Interest expense.
Interest expense, good. And we'll calculate that in a minute. What do I credit? Good. Discount on bonds payable. And we calculated that amount, right? It's the $40,559. $40,559. And then what else do I credit? Cash. Good. Cash gets credited the $350,000 interest payment. So the total expense of issuing this bond at a discount, I need to add these two together. Okay? So interest expense is debited for the total amount, $390,559. So what's happening over the life of this bond, just to kind of illustrate? You have the bonds payable. When we issued it, we issued, 10 million of bonds payable. That 10 million bonds payable debt is going to stay there until this bond matures. Okay. But now we've created this contra bonds payable discount on bonds payable, or BP for short. Again, it's a contra account, so it increases on the debit side. 405,585. Okay, when the bond was issued. So this was at year 1 issue. Well, now every time we make an interest payment, we're recognizing 1/10 of this. So we're crediting it. Okay. So over time, we're going to keep crediting this account, right? The next time we make an interest payment, we recognize another $40,559 in the discount. That's like December 31st of year one. And that just keeps going for 10 payments. Of course, they had us round it to the nearest dollar. But eventually, when this bond matures, when it comes due, this will be zero at maturity. We'll have recognized the total discount. So we're just spreading that discount over the life of the bond. So when we're all done, the discount becomes zero, okay? And when this matures, we pay it, the full face value, so at maturity. So then that zeroes out as well. Okay. So again, all we have to do is calculate the discount amount, calculate the amortized discount, calculate the interest payment. And then we were going to do that same journal entry, that second journal entry, every 6 months for 5 years. So on number 3, when it says the second semi-annual interest payment, you're literally doing the same thing. Interest expense debited, $390,559. Discounts on bonds payable is credited, $40,559. And cash is credited, $350,000. That's the same journal entry every 6 months for 5 years. They don't have it on here, but when this bond matures, we have paid all the discount, we've spread out all the discount, we've paid all the interest. We're debiting bonds payable for the face value and crediting cash. So interest is always calculated no matter how we issue a bond, the face value times the stated interest rate times time, okay? When we pay a bond back, it's always a debit for the bonds payable at face value, credit to cash. Okay. So interest is always calculated the same, and your maturity payment is always the same, okay? So that kind of helps a little bit. What is different is your issuance journal entry and then your interest expense recognition. Okay. So on B, it says determine the amount of bond interest expense for the first year. Anyone know what that might be?
781, 118.
You sound so excited.
Sorry, I need more coffee.
781, 118. All we're doing is saying, well, we made 2 payments of interest. So 390, 559 plus 390, 559. So in the first year, the total interest on the bond is those 2 added together. That's where the 781, 118 is coming from. And then see, it says, why was the company able to issue the bonds for only $9,594,415 rather than the face amount of $10 million?
Because the market was greater.
Exactly. Very good. The market rate was greater than the contract rate. So they could get a better interest rate on a different bond. So in order to make this bond attractive, we lowered its price. Okay, we discounted the bond because we're paying them less interest than what they could get elsewhere.
If a company's willing to do that, does this show the company's not doing too good?
No,
It's not with the market itself.
no, it has really nothing to do with the company's profitability or viability. It's really all market driven. So, the market's changing every day. So it could be when we issued the bond that 12% was the going interest rate, and maybe this bond got purchased a month later and interest has changed. You probably won't. I mean, again, we're using inflated interest to make it easier, but we're not going to see 12% interest rates or, an increase of 1% in the real world. But it's good for illustration purposes.
What would you say like normal is, like a 2 or 3% or a 5?
Honestly, I haven't looked at it recently. I would think it's pretty low, probably pretty similar to like savings.
Oh, wow.
I could be wrong. We could Google it. You could Google it and let us know. See, I just gave you a... Any questions so far on bonds? I'm probably going to stop there. We have about 15 minutes, but that's not enough time to cover the premium, so I'd rather stop there. So Tuesday when we come to class, we'll wrap up and do the premium, and then I may add like 1 or 2 more examples to work on that are a little bit harder, like your homework. I think there's some harder ones. If not, we'll do something fun. I'll show you amortization schedules on Excel. What'd you find?
About 2 to 6, and for U.S. Treasury, about as low as 1.5 to almost 2.8.
Okay, that's not too bad then. The bond rates, it depends again on where you're getting the bond and probably how long of a bond you're getting. Good.
It doesn't sound like it's much though.
2.6% interest.
Yeah.
Um,
It's a waste of time to even do